Chapter 2. Understand the interest rates. I will show you how to master the interest rate test, starting with the basics. There are currently two main types of interest that you pay on a mortgage: interest only and repayment. When it comes to interest only, as the term implies, you are only paying the interest on the original loan every month. The loan remains outstanding at the end of the term unless you have another way of clearing the debt in full. On the other hand, repayment means that you pay the interest every month, plus an extra amount that goes towards paying off the original loan amount. The good news is that after the end of the term that you have taken the mortgage, usually 25 to 35 years, the debt will be fully paid. The interest-only option is better applied to a situation where your cash flow is not in the best state, and you have no long-term plans for a certain property. This would be the best move for flats that you intend to sell in 5 to 20 years' time if they do not work well in your portfolio due to the service charge, which may increase. A repayment mortgage is a better option if you have excellent cash flow and you have managed to secure a competitive rating, preferably below 3%. All things considered, my preferred suggestion would be to take out an interest-only mortgage and make overpayments. That is, pay an extra amount over and above the agreed monthly payment. This gives you the power to pay up to 10% of the outstanding mortgage every year. This means that if the interest rates increase or decrease and your cash flow rises and falls, you can alter the amount of your overpayments to suit your situation. The amount of money you can save by simply making overpayments is amazing, and it is also possible on a repayment mortgage. It is about maximizing your money to its full potential. Take a look at the benefit of saving your money over a few years compared to the financial benefit of making overpayments on some mortgages. Should I take out a fixed rate or a variable rate mortgage? Variable rate is a specialized type of interest rate charged by a lender. It fluctuates over time because it is based on an underlying rate, which is normally the Bank of England's rate plus an extra percentage, 3% for example. If the Bank of England's base rate increases, then your rate will also increase. Hence, if the bank base rate decreases, then your mortgage payments will decrease accordingly. And if interest rates increase, so will your mortgage payments. So, if you are on a variable rate mortgage package, you are always vulnerable to interest rate movements. Fixed rate does what it says on the tin. The rate you agree will be the rate of interest you pay for the duration of the period of your agreement. Therefore, considering which one to choose and over what period is most important. This depends on you and your approach to risk. However, I like to think that I eliminate as much risk as I can when making these decisions. The common sense approach. If interest rates are high and it seems like they will keep increasing, then it would make sense to take a fixed rate mortgage, because this will protect you from any increase in your mortgage payments. Moreover, it will eliminate any uncertainty from the equation. Nonetheless, I suggest that you limit the duration of this type of product to 3 years.